Miss, your audio online is not too loud, and I believe some of the classmates here can't hear online, if that's the issue.
Whoops. Okay. Thank you for telling me. Is that better?
Yes, Miss, we can hear you.
Okay, great. Okay. Wow, I'm so glad someone unmuted and told me that I was still muted. That's great. All right, let me just get the chat up so I can see if there's any. Yep, okay. Now you can hear me. Great. Okay. Another one. AP, very good, very obvious. Another one, there's quite a few. Ruby. Notes payable, sure. Anything else? Can you tell me your name again? Pardon? Oh, yeah, that's right. We met at the job fair thing. Okay. Okay, what is the third one you're thinking of? Which payable? Bonds payable, sure. Bonds payable. Long-term debt, yeah. Lots of financial liabilities. Okay. So now we're going to talk about how we're going to value financial liabilities for accounting purposes. The only type of account that we really do not apply this rule to is AP. So in fact, we sort of fudge AP. That's a convention. We all do it. We just record AP at the face value and we ignore the time value of money. But for all the other financial liabilities, we don't ignore the time value of money. We have to allow for it. So to do that, we're just going to apply a very simple process to value all financial liabilities other than AP. We're going to think of them as simply a series of cash flows. So focus on the cash flows. We're going to map all the cash flows onto a timeline, and then we're going to discount them back. That's it. That's how we're going to put them on the balance sheet. Okay, so let's take the first example here. We have a $300,000 5% note payable due in 4 years. Map the related cash flows. So the principal cash flow, just by convention, if that's the way we call the note, then what you know by convention, even though it's not stated explicitly, is that the principal repayment happens as what we call a bullet or a balloon payment at the end of the 4-year period, like on the maturity date. And the interest, because I didn't say anything else, you assume the interest is paid annually. So what would the interest cash flow be that is paid in annually? What have we contracted to pay in interest each year? What amount? Ruby. 15,000. Yeah, so my interest cash flow contractually agreed, my face value of the note times my face interest. And that is paid at the end of the first year, at the end of the second year. It's paid out 4 times. And on maturity, you pay the interest for the last year plus the principal. So we're going to discount the cash flows back to today. The 300 and then the 15s. So the 300. Now on the exam, I can't give you Excel. We're going to do paper exams. So we have to go back to the Stone Ages, and I'm going to give you present value tables. If you have a financial calculator that you're confident in how to use, you're welcome to use that. Tell me what the attributes are that you're entering into your financial calculator so that if you hit a wrong button, I can see that, well, they knew what they were doing, but their finger moved. Okay, so for everybody else who's using the PV tables. My present value factor. I take my interest rate, which is 5%, and my number of periods, which is 4 years. And at the nexus of those two is my factor, 0.82270. That works out to 246,810. Then the factor, these $15,000 payments, identical amounts, right? Equal intervals. That makes them annuities, which means instead of doing 1, 2, 3, 4 calculations, present valuing each payment, we can just use the annuity table. Okay, has to be equal amounts in equal time increments, and you can use this table. So again, we look at the nexus of 4 periods, 5%, 3.54595. And on the exam, this is where some people get themselves mixed up. It's like, okay, I got the right factor. Now, the cash flow. Am I supposed to add these up, or is it just one of them? Yes. Already off the screen. Are we supposed to add them up, or just the 15,000? It's the annuity payment, which is 15,000. So don't give me 60 here, because now you're going to go off the rails. 15,000. Just the annual annuity payment. That works out to 53,190. Add it up. 0.00000. Oh. All that work to get to 300,000. You could have just told me 300,000, right? Okay, so that's correct. I just wanted to go through that to demonstrate that this process brings you back to a rational number. The thing that made that beautiful round 300,000 number is that the face interest and the market interest, which I kind of just bluffed right over, are identical. When they are identical, which is sometimes called the bond was issued at par, well, then the present value of the cash flows is the same as the face value of the bond. So this is issued at par, which means face interest equals market interest. So this is actually a special case that we're looking at. And this special case, I guarantee you will not have this special case happen on the midterm. I mean, it happens sometimes in reality, like in practice, but much more common, there is a difference between the face rate and the market rate. As you know, they estimate what the market will say is an appropriate interest rate for the company, but they don't know until it's done, until it's placed in the market and you find out, right? So it's actually in practice almost always different. So let's take this same bond, same legal name, but the market interest rates are 6%, different from the face, which is 5%. Now, the cash flows don't change. It's still 300 and it's still 15 because those are contractual cash flows, right? That's what's written in the note payable contract. So that doesn't change. What we promised to pay does not change. The factor changes because now I'm going to use a factor based on 4 periods, 6%. Get out my trusty table. 4 periods, now I'm at 6%, 0.79209. And for the annuity at 6%, 3.46511. Multiply it out. 237,627 and 51,926. 289,604. That means that when those notes were placed in the market, you know, and the lenders read, okay, I'm going to get 5% interest, they said, well, I'm not paying full value for those notes because I think the interest should be a bit higher. So I'll buy the note, but I'll discount it, right? These notes are issued at a discount, right? Face is 300. Cash actually received 289. They were issued at a discount. So what we would show on our balance sheet, I'm just going to write it up here, okay? Let's pretend this is our non-current liabilities section, and we're going to say 300,000, 5% note payable due December 31, year 4. And then I'm going to put down 289,604, not 300. That's common. Very, very common. It's the name of the note is not the same as the value of the note. They're different. Okay, let's look at another wrinkle. What we call discount notes or zero interest notes. So when notes are named zero interest notes, that's true from a legal perspective, but it's not true from an economic perspective. And in accounting, we try to do the accounting for the economic substance. So even though it's a zero interest note, we're still going to accrue interest every year on this note, on the zero interest note. We will. Okay. So I think discount notes is a more descriptive name. Anyway, I'll show you how a discount note or a zero interest note works. A discount note being distinct from a note issued at a discount. Okay. This is a regular note issued at a discount. A discount note, usually what we mean is it has zero interest. So if we have a 300,000 0% or 300,000 discount note payable due December 31st, year 4, that's just telling you what the cash flows are. And the cash flows are, there is one cash flow associated with this note. It's the principal cash flow at the end of 4 years. There is nothing for interest. So I just need you to understand what the naming convention is telling you. So that's what it's telling you. Market rates are 6%. So I'm going to take my 300,000. Still 4 periods, 6%. So it's still 79209. Still 237,627. But we have no interest. So on the books, that discount, that $300,000 discount note would be carried at 237,627. Everybody good with this? This is how we value notes, bonds, long-term debt. Something like a bank loan, though. Bank loans are one of the things that are typically issued, you could say, at par, because you're negotiating with the bank. The bank sets the rate, Well, that's the market rate, right? They've decided that's what your credit is worth. So bank loans tend not to be different. Their face and their carrying value is usually the same because we assume the market rate is what the bank says, you know? And the bank loan is very specific, and we have this security. So the bank, which is a sophisticated lender, is deciding that the rate that they agreed with you is the market rate. But for bonds and notes, where you have a bunch of people in the market who are collectively setting the price or the value, let me see if someone said something. That's where we have different values on the books from the face. You need to be able to do this process. Basically get the bond value. 2 marks for that on the exam. I guarantee you, I will ask you to do this. Now, you'll see the different ways it can twist and turn, but for sure, I will ask you to value a bond or a note. It's kind of the first step of everything in this chapter, so I basically have to ask you. So I've just told you what was on the exam, right? Part of it. Okay, let's do online assignment 1 and start getting into these little twists. On May 1st, 2027, Jadeja Corp issued 200,000 of 5-year 8% bonds. Okay, so they're giving me the name of the bond. That's face, and that's face. With interest payable, oh, it's semi-annual interest, so that's like a new twist for us. The bonds were issued to yield. That's a synonym for the market rate. A market interest rate. They could have just said to yield 6%, and that would have been good enough. So this is my market rate. Jadeja uses the effective interest method. Of course they do, because it's a publicly listed corporation, which means it uses IFRS, and IFRS requires the effective interest method. That's the method we've been using thus far. I'll show you the other method in a few pages. Okay, map the cash flows. Well, I go to the name of the bond to figure out what the cash flows are. The principal, 200,000 on the maturity date. Interest cash flows. Face times face. 200,000 times 8% interest, but it's semi-annual, so times 1/2. 8,000. So on December 1st, I make my first semi-annual interest payment of 8, and then on the 1-year anniversary, another payment of 8, 8, 8, all the way over to the maturity date. Every 6 months, we make that 8,000 payment. When we're discounting these cash flows, right, the 200 back to today and all the 8s, back to today, we need to use a semi-annual interest rate. So what is the semi-annual interest rate we will use? Luca? It will be 3% because we're going to take the market rate and divide it by 2. So my PV factors are going to be based on 3% and how many periods? 5-year, but the interest periods are, yes, it will be 10 because the interest periods are semi-annual. So 3%, 10 periods, not 6%, 5 periods. Let's get the factors. 10 periods, 3%, 74409. 10 periods, 3%, 8.53020. Oh, it's because I'm hitting this thing. Okay, came back. Okay, good. All right, my principal cash flow, 200. My interest cash flow, don't go 8 times 10 payments. It's just 8,000. Just the annual payment or the semi-annual payment. And that works out to, just 1 second, because definitely cannot calculate this in my head. 148,818 and 68,242. 217,060. The value of the bonds on the issue date, which is the present value of the cash flows, is 216,000. That's what the lenders gave me in exchange for issuing all the bond contracts to them. Was this bond issued at a premium or a discount? Yes, at the back. Yeah. It is at, how did you know it was a premium? Yeah, because 217 is higher than the face of 200. That's the premium. The premium is 17,060, right? This bond was issued at a premium. Okay, the journal entry, the other 2 marks. So 2 marks for doing this and 2 marks for doing this journal entry. This is 4 marks. The midterm is out of 40. 10%. You cannot miss getting this, okay? You got to give yourself this 10%. What is the journal entry to record the issuance of the bond? Yes. Yes. Is it a bond or a note? It is a bond. I mean, you're going to get those 4 marks. Everybody going to get those 4 marks? Get them. This is the best chapter on the midterm. I almost always have the highest average mark on this question. And because I have to start here. 4 marks. Get them. Okay. On November 1st, so the bond was issued in May. On November 1st, we do our first interest payment. Interest expense is the outstanding balance times the effective interest rate, which is the 3%, which equals 6512, debit interest expense. I actually pay my bondholders. I pay them cash. That's contractually agreed. How much cash do I pay them? Sorry. How much cash do I pay my bondholders? Contractual. Luca? 8,000. We already calculated it, right? 8,000. That's what I'm paying. 8,000. Okay, wait. I'm not balancing. I need a debit of 1488 to balance. What account am I going to debit? Yes. It is the bonds payable account. Okay, great. 6 months later, 1-year anniversary, got to pay interest again. Now, when I calculate my interest expense, I calculate based on the new outstanding principal balance. So the new balance is 217,060 credit, right? That one. But now we have this one, plus 1488 debit. which is 215,572 credit. Okay, 215,572 times 3% is 6,467. So now I do virtually the same entry again. My credit to cash. What is the amount of my credit to cash? Go ahead, Luca. Yeah, 8,000. Got this difference again. 1533. Whoops, that's a debit that I need. Bonds payable. Pretty straightforward. Very straightforward process. So at this point, on May 1st, the bond was on our books basically at 217. Then after the December 1st payment, it was at 215.5. Then it's at 215.5, and I'm going to debit it by 1533. It's going to be basically 214. If I keep going, what will the value of the bond, the carrying value of the bond, be on May 1st, 2032? Luca? 22? Yeah, it'll be exactly 200,000, like 200,000.00. I mean, because what are we doing here? We're chipping away at the $17,000 premium. We keep chipping it down, chipping away every time, chipping. It's going to end up at exactly 200,000. Why? Because it's a present value calculation. We made it so, right? So that's how we chip away at that premium. We kind of use up the premium as we pay interest each time. So that on the day the bond is due, even though they gave us 217,000, we're going to repay them 200,000.00. Right? That's how it works. All right. This is a hard question. It's kind of one of the, I think it's maybe the only hard question in the online assignment questions. I think the rest of them are all pretty straightforward, but I thought this question was clever. So Big Country sells cattle. They've got problems. They issued a 280,000 6-year 0 interest bearing note. Okay, we know legally true, economically not true. There is interest. We know this is going to be issued at a discount, right? Because there's no such thing as no interest. Okay, so they issued the note to Little Town on January 1st and received okay, look, it looks like it was issued at a discount. Good. In addition, they agreed to sell cattle for an amount less than the regular selling price over the next 6 years. Oh, the market rate is 8%. So we always value our notes by discounting the cash flows. So let's just verify this. So this note, based on its name, has one single cash flow of 280,000, has no interest. So it's just that one cash flow. 280,000 times my factor. For discount notes or 0 interest notes, I already mentioned this, right? We assume that the 0 interest is paid annually. So don't go and randomly say, yeah, but I think the 0 interest should be paid semi-annually. That's not the convention. It's annual. So we're going to do 6 periods and 8%. 6 periods, 8%. I'm on the wrong table. It's a lump sum. Okay, 6 periods, 8%, 0.63017. That works out to 176,448. My interest is 0, so I'm at 176,448. Okay, so that's weird. Let me just get my journal entry down. I know that I got cash. Okay, so I'm going to put the cash coming in for 200. I know that my note payable should be valued at the present value of future cash flows. So I know that it should be 176,448. I'm not balancing. I need another credit of 23,552. What is that credit? Yes. Yes, it's unearned revenue. It's unearned revenue. They're going to sell their cattle for an amount less than the regular selling price. So it's as if Little Town gave them a deposit against future sales, right? It's like they prepaid for sales because, maybe Little Town doesn't want their town to go bankrupt if this big operation in the town goes under, so that the town is trying to help them. So they're lending them money, quite risky, right? Because when you lend money and nothing gets paid for 6 years, like a lot of things can happen in 6 years. If you have no interest payments, there's kind of nothing that they can do wrong. They just get to keep that money for all those years, and you cross your fingers and hope that 6 years later they will pay you $280,000 in cash, boom, in a bullet. It's that's risky from the lender's perspective. And in addition, they also prepaid for beef that they're going to buy. Yep, this is unearned revenue. Okay, let's look at 1410 now. Just these 4 independent situations. Okay, on March 1st, 2027, Wilkie issued 4 million of 9% bonds. Okay, so I know what that means. I could think about the cash flows that they're telling me right there.
Yes, sorry, I do not want to interrupt, but online I think your camera is kind of blurry.
What's happened online?
Um, Online your camera is blurry, so the screen you're showing is just hard to see right now. You can fairly make it out.
Yeah, it's quite blurry, right? How's that?
That's better, miss.
Okay,
Thank you.
thank you. Thank you for telling me. Okay, did you guys not see that thing was blurry? Was it not blurry here? Okay, whatever, not that. Okay. All right. So on March 1st, Wilkie issued these bonds at 103 plus accrued interest. First of all, when we say at 103, what does that mean? Vigin. What does it mean? They're issued at a premium. At exactly what premium? At 103% of face, right? That's what it means. You think of it as a percentage sign behind it. When they're issued at 103, that's the percent of face value that was received, okay? So it means Okay, so we got that part. Plus accrued interest. I mean, what does that mean? These bonds are a bit, maybe we could say they're a bit unusual. On March 1st, they issued bonds, okay, dated January 1st. So the bond contract is dated January 1st, but they didn't issue them till March 1st. I don't know why, but that happened. The bond contract dated January 1st will say interest is paid semi-annually on July 1st and January 1st. So on July 1st, the bond contract will say that interest is payable, and it's going to be payable based on the 6 months from January 1st to July 1st. But Wilkie didn't have the money for 6 months. They only had it for 4 months, right? So what's going to happen is that the lenders are going to give Wilkie the first 2 months of interest, and then on July 1st, Wilkie's going to give them 6 months. Why do they do it this way? You know, it's just legally. You know, that's what the bond contract says. So we have to make these arrangements kind of outside the legal contract. So that's why it's plus accrued interest. In practice, I'm not sure this happens so much on issuance, but you could buy a bond today, September 16th. It's just a random day in the year, right? But if that bond pays interest on July 1st and December 1st, right? If you buy the bond on September 16th, on December 31st, you will get 6 months worth of interest on that bond because that's what the contract says. What you have to do when you buy the bond on September 16th is you have to give the previous bondholder the interest from July 1st to September 16th, right? So you give that to them in addition to buying the bond. And then on December 31st, you get 6 months interest. This is just the way we have to do things because the dates are so rigid. Okay, so that's what's happening here. So I'm going to show you my solution so I don't have to write this all out. The bond buyers will actually pay Wilkie 2 months interest up front. Wilkie will then pay the lenders, who are the bond purchasers, 6 months interest on July 1st. Net equals Wilkie paid 4 months of interest, which is what he should pay, right? Because it's only outstanding. They only had use of the money for 4 months in that first interest period. Okay, so you guys know that these solutions are posted, right? All these solutions in my very best handwriting with all these beautiful colors posted after we do the second class. It's in the like long-term liabilities 2 webpage, in the current and non-financial liabilities 2 webpage. Not this chicken scratch that I write here, but I took my time. I tried to print very carefully. Okay. So I just want to emphasize this point. The issuer, the borrower, in this situation, is going to be paid interest up front, which they will then pay back when they pay 6 months interest later. Okay? Okay, so they receive additional cash. Wilkie receives additional cash. And we understand why that is. It's kind of weird, but that's what happens. So then let's calculate the net amount of cash received by Wilkie. First of all, the bonds are issued at 103. So 4 million times 103% is 4,120,000. Is that right? It is. 4,120,000. Accrued interest. So remember, they're going to give us 2 months so that later when we give them 6 months, they will net have 4 months. 2 months at the interest rate of 9%. 4 million times 9% times 2 months over 12 is 60. And it did say Wilkie incurred 27,000 of bond issuance costs. So that's what they paid to like the investment bankers who placed the bond issue on the market, 27,000. So net cash received would be 41.53. So that's how it really works in practice. In our case, I could ask you about this, but I wouldn't, I'd ask it as like a side question, not as the main question. So the way you would do your calculation for the very first entry would be like this, okay? Like this is the type of thing you'll have to do. And if I ask you something about accrued interest, I'll do it like as part D, not as the main question. The other thing is, usually in our questions, we pretend that issuance costs don't exist. So again, I would ask you something like these 2 items, potentially as a side issue, not as like the main question. Like, I don't want to confuse everybody. We're trying to get the basics down here. So these are like part C, part D type questions. Okay, let's look at situation number 2. On January 1st, 2027, Langley issued 9% bonds with a face value of 500 for 469 to yield 10%. They gave us everything, right? They gave us face interest, face value, they gave us market interest, and they basically gave us the present value. I mean, that makes it easy. We don't have to like do these calculations to figure out this amount. It's already been done. The bonds are dated January 1st, 2027. Good. So no accrued interest. And they pay interest annually. Good, because that makes it easy. Langley prepares financial statements in accordance with ACCT. What amount should they report for interest expense in 2027 related to these bonds, assuming that it uses the effective interest method? So this is the method that we've been using the whole time. And the way we do it, we take the outstanding balance, which is the present value, 469,280 times the yield, or the effective interest rate, or the market interest rate, which is 10%. I can do this one in my head. 46,928. That is the interest expense. Could Langley choose to use the straight line amortization approach? Yes. It's another approach. ASPE allows it. Do you think IFRS allows it? That would not be like IFRS, would it? They don't. You know what? Because it's simple. The straight line approach is simple. IFRS doesn't like simple. No, IFRS likes conceptually sound. Simple is not always equivalent to conceptually sound. So the answer here is yes. ASPE allows effective interest, which is the IFRS approach, or straight line. So if we filled out this little table, GAAP applicability, effective interest approach, IFRS regime allows it, ASPE allows it. Straight line approach, just ASPE. Key benefits of the effective interest approach. I just said it, conceptually sound. The straight line approach, simple. That's the key benefit. Calculation approach. Interest expense equals the present value of the bond as it currently stands times effective interest rate, right? The market rate, the yield, the effective interest rate, that's how we calculate it. Interest expense calculation here is a little bit indirect. I guess I'll show you the calculation approach in a minute. I think it's on, where do I do it? Yeah, I do it in the next question. So let's just wait for it. But under the effective interest, interest expense changes every period. Right? We already saw that. It was the interest expense first it was 65.12, then it was 64.67. Then it's going to be something a little bit higher. Then it's going to be, it's always, every single time the journal entry is going to change. With the straight line approach, and this is what makes it simple, JE, journal entry, is repeated. Identical JE. Every period. And I'll show you how we do that. But the point is, the interest expense and the journal entry changes every time. Under straight line, you set it up once and you just repeat it. Okay. Chico, 152. Okay, we're good. Chico, private company that uses ASPE, has several long-term bonds outstanding at the end of 2027. These bonds have the following sinking fund requirements and maturities for the next 6 years. Indicate how this information should be reported. First, what's a sinking fund? Does anyone know? If you were a borrower, would you want to have a sinking fund? Anybody? Sinking fund? Sinking fund, as part of your loan agreement, you agree to deposit cash in a bank account that's held in trust. So you own the bank account, but you're not allowed to take the money out. So let's say you have, well, like this company. It's not laid out loan by loan here. But in 2028, you're going to have to put $300,000 into a sinking fund bank account, which is an asset in your name, cash, like restricted cash, because you can't use the cash. Just put it in there. You're not paying back your loan. You get to earn interest and you get to take the interest on that 300,000 that you put in there. But you're still paying interest on the loan. Okay, so would you want to have a sinking fund requirement in your loan agreement? If you owed the bank money, would you like to put money in a bank account with the bank and keep paying interest on the loan? The bank account will pay you interest, and you can't get the money back out of the bank account. Do you think that the interest in your deposit account will be as high as the interest you're paying on your loan? So who would want that? You don't want a sinking fund. If the company has sinking funds, it's not in a strong negotiating position with the bank, right? They had to agree to this crappy deal where the bank continues to charge you high interest for lending you money and they pay you a pittance for putting your money, like they don't want you to pay it back because then they don't get interest from you, right? They'd rather have your cash, lend it to someone else, plus keep paying interest on the high interest loan that we lent you. Not good. I mean, the bank is worried that Chico is not going to be able to pay, or, you know, the note holders or the bond holders, they don't trust them. They have a weak credit, you know, their credit score is low. So a sinking fund, you know, you're not paying back the loan. So I'm just going to show you what, because I write it out so nicely here. A bank account owned by the borrower but held in trust for the lender. The borrower deposits installments to the account, demonstrating to the lender that they will have sufficient cash to pay the principal on maturity. Yes. Oh, you couldn't see it after all that? I put it too low. So when the loan comes due at the end, you know, they take the money out of the account now and you give them the last bit because you've been putting away money in preparation for paying this loan all these years. Do financial statement readers need to know about upcoming maturities? Yes. What about upcoming sinking fund payments? Yes, they do. So we will definitely have to disclose this. Have I talked yet about what financial statement users use the financial statement for? Like when I'm talking about financial statement users, I'm not talking about, you know, my grandmother used to receive all these annual reports and we'd go over to my grandmother's house and these things would be sitting on the coffee table and like they're just nice glossy looking things on the outside, right? I'm talking about users like analysts and stockbrokers, but they're really just the sales guys. It's the analysts who do the work to really read the financial statements and use them, and then they feed that information to the stockbrokers, and the stockbrokers might sell to you. So what is it that the analysts do? These guys down on Bay Street and Wall Street, making a lot of money, and as they told me, boring themselves to death. What are they doing? They're deciding whether or not to buy. Yeah, should I rate this as a buy, sell, or hold, right? How do they know? What do they do to make that decision? They look at the financial statements and what are they looking for? See if the company's profitable. They look at their debt. Yeah. You know what? I mean that's kind of at a high level what they do. But what they really do is the honest truth. They do this. Except the cash flows that they're looking at, how much revenue do I think they're going to generate? What about their revenue in Asia, their revenue in South America, their revenue in North America? In all these different divisions, what are their costs going to be? Do they have a good marketing plan? They have massive, massive models of every cash flow that they think is going to happen. And they discount those back. And they don't use like necessarily one interest rate. They say, well, that's risky. So I'm going to use a higher discount rate for this. And I'm going to discount these other payments at this rate. They, when they decide on buy, sell, or hold, it's a giant, giant cash flow model. If you ever listen in on an analyst call, you can see that that's what they're asking for. What do you think the growth rate's going to be in Asia this year? Do you have visibility on this? How's that capital expenditure going? How much is it going to be? Like, how much will you spend this year, next year, and the next year? All these cash flows are being discounted. They're all getting plugged into their models. They discount it all back. That becomes the value of the company. Divide by the number of shares outstanding equals a target share price, and they compare that to what the market is right now. That's how they know, buy, sell, hold. It's a big cash flow model. So do they want to know about upcoming maturities? Yeah. That's why those guys, they read the notes. For one of my research projects, I interviewed these guys. I have to say, they were smarter than I thought they'd be about accounting, you know? Like they knew the accounting. You guys who are doing CFAs, these guys know the accounting. They read those notes. They know exactly what we're trying to tell them. And it's all for plugging into their giant cash flow models. So when cash is coming out of circulation, I mean, they want to know that. All part of their giant model. The more precision they can get in their model, the better. The less risk their model has, right? So they want to know everything. Yeah, it's interesting that when you hear their questions, you can just see you're asking this for your model, for your model, for your model. So yes, they need to know maturities. And yes, they need to know sinking fund because that money is not available. And why? It's for cash flow forecasting purposes. It's like a bond discount model, but much, much, much more complicated. Okay. In the long-term debt structure of Cheslaw, the following three bonds were reported: mortgage bonds, collateral trust installment bonds secured by plant and equipment. Do the listed long-term debts of Cheslaw, oh wait. Well, I want to know if any of these are debenture bonds, okay? That's the bottom line question. Does Cheslaw have any debenture bonds? And the way debenture bonds are defined as bonds that are unsecured. They don't have security. So you tell me just based on the name. 10 million mortgage bonds payable. Do those bonds have security? Yes or no? Yeah, because that's what a mortgage is, right? A mortgage is the part where you have already signed the ownership of your house over to the bank. contingent on you not paying your loans. That's what the mortgage part is. Not the payments. It's the I already signed ownership over to the bank contingently. That's the mortgage part. 5 million collateral trust installment bonds. Do they have security? Because collateral is security. 4 million installment bond secured by plant, obviously. So does Cheslaw have any debenture? No, because they all have security. Companies that have debenture bonds are either extremely strong, so they can tell the bank, no, I'm not giving you security, or the bondholders, nope, I'm too strong. I'm like a AA credit. Don't ask me for security. It's actually insulting. Or they're at the other end of the spectrum. They don't really have any assets to give, and the interest rate is going to be high. And these are bonds that we would sometimes call junk bonds, very high risk bonds. There's no security, and the interest rate is very, very high. Okay, how are we doing for time? Oh, we're doing so well. Let's do Mosca. On June 30th, Mosca issued 4 million of 20-year 13% bonds for 4.3 million. Wow, they did it again. They gave us the market rate, they gave us the present value, and they gave us face and face. Great, we don't have to calculate it. The company uses the effective interest method. The bonds pay semi-annual interest on June 30th and December 31st. So to record the issuance of the bonds, why don't you write it down? Just practicing, right? For the midterm. So I'm assuming you did debit cash, credit bonds payable, right? For the present value, the 4.3 million. Just as an aside, was this bond issued at a premium or discount? Yes. Premium, because 4.3 million is higher than 4 million. That's a premium. Okay. Charge interest on the outstanding principal balance. You know how to do this, right? What's my effective interest rate? Yes, Maha. It would be 6. Good. You didn't forget about the semi-annual part. So you picked up the market rate and you applied the semi-annual. That makes it 258,055. Okay, go ahead and do the journal entry. What is your credit? What is your credit? Can someone tell me what this line is? Credit? What is it? Yes. Yes, credit to cash. And how much cash did you credit? How much? That would be the interest expense, right? The 258,055 is the interest expense. Ruby, was that you? Good. Because it's the interest cash flow, right? Which is face times face, which is 4 million times 13%, but it's semi-annual. That's 520 times 1/2, 260. So then we need a debit, 1945 to balance, to bonds payable. And again, we see it happening. Oh yeah, that was issued at a premium. And now I've got, wow, that's a 20-year semi. I got 40 payments, and I'm starting to chip away at that $301,000 premium. The first chip is for $2,000. Yes. It doesn't matter. You could put them in any order. You could even put a credit first, but I always do a debit first. You'll see in tax, maybe not, but almost all the time I do a debit first, and then I kind of figure out what I know next. And when I have a force, because this is a force, right? I'm just making it balance. I just let it, I just let it be, whatever it is. It might be a debit, it might be a credit. This time it's a debit. You don't have to do it all debits followed by all credits, but you can, like whatever way you want. As long as I have a balancing journal entry, the order doesn't matter. Okay, so the June one, I'm going to tell you adding these two things together, right? This plus this, right? 4,298,975 at 6%. It's 257,939. So why don't you do the journal entry for June 30th, 2028? How's it going, Lucas? 939. Oh, you got 758. 4298. Yeah. Is everybody getting this? I'm just looking over people's shoulders. Okay, can you scroll down? I want to. Uh-huh. Yep. Looks good. Yeah. Okay. Well, one person got it, so I'm assuming everybody's going to get it. So it's 257,939 because we calculated that. This is always 260 because it's the interest cash flow. And then I need 2061 to balance. And I'm going to put that through bonds payable because it's a force. And then the next one Interest is 257,815. 6%, and we would have to adjust the outstanding balance by 2061 for 296,914. And it's 2,185. Okay. Show proper presentation for the liability for bonds payable on the December 31st, 2027 balance sheet. So our caption, we could put a really nice caption in here. Instead of just bonds payable, we could say 4 million, 13% bonds. Due June 30th. We issued in 2027, so after 20 years. 2047? So what would the amount be on December 31st, 2027? What would the amount of the bonds be? It's either going to be this amount, or this amount. Which one is it? Yes. Yep. Can you yell that? Yeah. It's this one, right? Because this journal entry happens on December 31st, so the carrying value is right here. Yes, that's the value that we're going to use to calculate the June 30th, 2028 interest expense, but that's because it's been outstanding at that value since the last interest payment date, which was December 31st. So it's 4,298,975. These two things don't match. That's normal. Interest expense reported for 2027. Well, since the bond was issued on June 30th, we only had one interest period. So the interest expense, 258. Okay. Now we're going to do the straight line approach. So easy. But different from what you're used to doing. So it's like I find it hard to do cash accounting because I can't unwind my head from accrual accounting. Straight line interest, it's easier, but you have to think about it because this is not what we normally do. So we take the original premium. So 1, calculate the premium or discount. Calc premium or discount. Usually, it's very easy to calculate the premiums. What is the premium on this bond? Nathan? Yeah, because you just take that minus 4 million. You can do that in your head. When you've got a discount, it's more complicated, right? So yes, so the premium was 300,920, the excess over 4 million. Then we take 2. Determine number of interest periods. How many interest periods does this bond have? Luca. 40. 20 years, semi-annual. Three. Premium divided by periods. It is 70 to 53. Okay, that's the amortization. You could say that we are amortizing the discount or the premium at every interest period. So that means that in the case of our entry, the debit to bonds payable is going to be 72.53. We know that the credit to cash is 260. And therefore, we actually force interest expense. We don't calculate interest expense directly. We calculate this. We know the cash, so that means whatever it takes to balance is the interest expense, which is 252, 477. 40 times that journal entry goes on to their books. 40 times. Lily. 40 times. That is easy, right? That is not complex. It's just hard to remember how to do it when you're used to doing it this way. But you know what? This way is conceptually sound. It's IFRS. It's ASPE allowed. It's better. But this is simpler. Okay, so having done this, now you tell me the 2027 interest expense under the effective interest approach will be the same as, less than, or more than the interest expense if we'd use the straight line approach. Oh, we're done. Think about that.
Sorry, can you just slide that just so we can talk?
Yep. We're done, we're done, we're done. Okay, you're going to tell me the answer. Like the numbers are right in front of you, right?
Very excited, then you're going to